In this video, we're going to talk about ethics, but in general, we're going to try to explain the behavior of managers. How should they act? How do they act? And we'll talk a little bit about some regulations and how that has an influence on management's decision making. But business ethics in general are just rules, right? They're standards of conduct, things that I'm sure you've heard of, the golden rule, right? Do unto others as they do unto you, etc. So if we violate these rules, then there are consequences, right? Most of the time, the idea is it is negative publicity, and negative publicity is never good. But ethical rules or ethical violations are not necessarily illegal, right? They're not a violation of the law. Sometimes they're just things that are done that, in quotes, aren't right, but they're in violation of what the investors of the company want. So what that leads us to is a concept called agency. And there's a principal-agent relationship between the company, the principals, the owners of the company, and the management of the company. So when management does things and place their personal goals ahead of the shareholders, that creates what's referred to as an agency problem. And agency problems have costs. So if you look at a decision that management makes, we need to ask a very simple question. What will that decision do to the revenue of the company? Will it create revenues? And if the answer is no, it only creates costs, that could be part of an agency problem. So whenever a manager owns less than 100% of the firm's equity, there is a potential agency problem. And I think this makes a little bit of sense, right? If you think about a sole proprietor, right? A single owner has no employees. They have their own business. Would that person ever do anything that would damage their wealth? I mean, I'm talking do anything on purpose to hurt the wealth of themselves. Now, they can make mistakes. That's not what we're talking about. We're talking about taking an action that detracts from the wealth of the owners. So in theory, managers all agree that they should be trying to maximize shareholder wealth. However, they have personal goals, right? They're concerned about their own personal wealth, their security, lifestyle, etc. So in this case, what can happen is that managers might act in ways that are contrary to what shareholders want. So how can we get managers to act in shareholders' best interest? One of the ways we can do this, or two of them actually have to do with the labor market, but primarily we have to think about employment. If managers can't get the job done, shareholders fire them. So how many times can you be fired, right? Hired to be the CEO of a company. You don't make your shareholders happy and they fire. How many times can that happen before you really start to damage your value, right? The amount that you ultimately get paid. In addition to that, if you think about the labor market for takeovers, right? If you can't get what shareholders want, that is, if you can't get the stock price to go up, the stock price is lower than it should be given assets, opportunities, etc., another company can come and take over your company. And of course, if you know anything at all about mergers, what happens in a merger is that normally the company being taken over, that management team is fired because they can't get the job done. Of course, we can audit the books, right? We audit the books to give us some assurance that management is doing and reporting, being very transparent with the transactions within the company. And of course, we could just pay them the right way. So how should you pay managers so that they act like owners? Well, you need to pay them as an owner, right? You need to pay them with stock. So we could do that with stock options. Now, there's lots of reasons why there are stock options. This just happens to be one of them. But an option is the right to buy a stock at a certain price within a certain time frame. What this does is it creates an additional place for the employee to buy stock for the company. So you can either buy it from the stock market or you can buy it from the company through this option. And of course, you're always going to buy it at the place where it's the least expensive. So if you have an option to buy a share of stock at $50 and the current price is $35, of course, you would go to the market, the stock market, and buy the stock there because that's where it's cheapest. But after several years of good management, if the price rises to $65, you now have a piece of paper that says you can buy this for $50. So where would you buy the stock? Would you give 50 to the company to get a share or 65 to the stock market to get a share? And of course, the answer is you would buy it from the company. So options are a way of helping managers understand the wealth idea, right? If they make good decisions, they're not just making the shareholders wealthy, but because they are shareholders themselves, they're making themselves wealthy. Corporate governance is all about the rules and processes for which the company runs, right? This is a document of sorts, right? There's some documentation that defines the rights and responsibilities of all the participants. How should the shareholders be acting, board of directors, managers, other stakeholders? What are the rules in place? Now, one of the most important pieces of regulation in recent times has been the Sarbanes-Oxley Act. And I'm sure you've heard of this before. But really, this act came about because of the some of the scandals, but also it relates to the actions around the market crashing. So they're all sort of related to each other. So the Sarbanes-Oxley Act basically does two things that I think are important. Number one is it establishes the structure and membership guidelines for the board of directors. It gives more guidance on how they should be acting. But I think more importantly, what it does is it toughens the penalties and requires the CEO and CFO to sign off on statements, on the financial statements, on the audited statements. Now, prior to the Sarbanes-Oxley Act, if management, because the CEO and CFO always signed the documents, but if there was something unethical or illegal, the penalty was always a civil penalty. Now it is a criminal penalty. So again, these folks, if they do something wrong, we know they don't want to go to jail. So this provides higher quality, more structure in the operations and the disclosure information by the upper echelon of management. So I hope you like this video. I look forward to seeing you soon.